Chris Hensley is a registered representative of Cambridge Investment Research, Inc., a broker-dealer member of FINRA SIPC, investment advisor representative of Cambridge Investment Research Advisors, Inc., a registered investment advisor. Cambridge and Houston First Financial Group are not affiliated.
The Houston Midtown chapter of the Society for Financial Awareness presents Money Matters with your host, Christopher Hensley.
Good morning, everybody. You're listening to Money Matters on KPFT Houston. I'm Chris Hensley. The time is 11 a.m. We've got a great show lined up for you today. If you have heard me talk about retirement, I always talk about this thing called the three-legged stool. The three-legged stool has to do with how somebody establishes their income in retirement. And if you have one of those legs broken, you're not going to be able to sit on the stool. The stool is comprised of Social Security. It's comprised of pension and retirement savings through work or an employer-sponsored plan. And then there's a third leg called Other. What could fall under Other? Well, more and more seniors are turning to the equity that is in their home. We have a guest today with us who will do a deep dive. His name is Eric Rittmeyer into the reverse mortgage. In fact, he is the first, one of the first people to receive the designation of certified reverse mortgage professional in the United States. So keep listening. Stay tuned. We will do a deep dive into that topic. But if you are a longtime listener, you know we always reserve just the first few minutes of the show here to tell you a little bit about what's going on in financial literacy and financial education in the Gulf Coast region. We are here just about into October, almost at the very beginning of October of 2018, but we are getting ramped up already for Houston Money Week 2019. And even though this is something that takes place in April of next year, it is an event that each and every month as we get closer and closer, it gets bigger and bigger, and we have more partners, nonprofit partner schools, banks, credit unions join on board, local city government, you name it, join on board to help bring free financial education and financial literacy classes to the Houston and the Gulf Coast region. Reason I'm talking about this is we have already had our first meeting this month. For people who want to find out about it, I would recommend going over to HoustonMoneyWeek.org. Now that'll tell you a little bit about what the nonprofit initiative is, or the citywide initiative is, and what we're doing. But as we get closer to the event, you will be able to put your zip code into a calendar and find events that are local to your neighborhood, or if you're trying to key in on one specific topic like taxes or credit repair or retirement or anything like that, you can see which areas in the city. But we always offer these free at no cost to the participants. Now, on the other hand, if you are a business here in Houston and you have space available and you'd like to have a speaker come out, that is one way that you can help, is by actually sponsoring a seminar, sponsoring a workshop, and having one of our partners from Houston Money Week come out during the month of April to bring this information to you. To find out more, you can visit www.houstonmoneyweek.org. And with that, let's go ahead and get Eric on the line here. Eric, are you there?
I am, Chris.
Excellent. Well, thank you so much for joining us today.
Absolutely. Thank you for having me.
Sure. I don't know if you heard the opening there, but one of the things we were talking about is more and more seniors turning to reverse mortgages as a way to kind of supplement their retirement income.
Yeah, I did hear the intro. Yeah, and that's something that fortunately this program is really finally starting to kind of grab hold. It's been around for a long time. A lot of people don't know. FHA actually started insuring reverse mortgages back in 1988. And it really wasn't until recently, in the last 5-7 years, where the financial planning community really started to take a deeper look at them. Because you're right, I did hear what you said in the intro here, and you're absolutely correct. I mean, for the longest time, the equity in someone's home was just really not being looked at as an asset that you could access, because basically you had to sell your property normally to access the equity that was built up. This program gives people the ability to access the equity without incurring a monthly payment and still maintaining ownership and staying in the house.
And I've seen this industry change. I have to admit that now I within the past year have got my retirement income certification, RICP certification, and the reverse mortgage. It's changed from I remember 10, 15 years ago, late night television commercials with people say, hey, reverse mortgage, but it's really a different animal nowadays than it was 10 to 15 years ago. I want to back up just a little bit because I forgot to introduce you here. Now, you are a veteran of the United States Marine Corps, and you actually founded Fidelis Mortgage back in 2006. In 2010, you were the first person in the United States to obtain the designation of Certified Reverse Mortgage Professional, and you speak regularly at just about all the Realtor Associations in Maryland, where you live. So tell us a little bit, how did you get started in the industry or in this business?
Sure, yes. I've been in the mortgage industry since the mid-1990s, and back in 2006 when I started my company, I went directly for reverse mortgages, and it's all we do. We're exclusively 100% reverse mortgages. And the main reason why is just the need was there. I mean, it was a product, and still continues to be a product that is very misunderstood. A lot of people are afraid of it. A lot of people have heard things or read things that they can't even confirm where they heard it from, but they just heard something bad about the program. So for me, I was kind of drawn to that because it was such an amazing product that, I've worked with thousands of clients. I've seen what it does for them, for their quality of life, when they're able to access some of that equity to pay off an existing loan, to eliminate a payment, to do home repairs, to pay off debt. I've seen what the product does for people, and it's something I'm latched onto. I mean, the clients we help are amazing. They want to stay in their house. So it's just a great product, very misunderstood. So I just went right after it. The demographic is there, so it was a good thing.
Absolutely. Well, let's start right from the beginning, because there are listeners out there that have never even heard of this. What is a reverse mortgage? Yeah,
absolutely. So, I mean, the simplest way to put a reverse mortgage, Chris, it's just it's a mortgage against the property that has deferred interest. So, one of the biggest misconceptions we hear, a lot of people think that when you do this loan that you're transferring title or the bank takes over. That's not accurate. A reverse mortgage, the youngest person has to be at least 62 years old. They have to own the property. It doesn't have to be free and clear, but they can't be a renter, obviously. They have to own it. Basically, tied to their age, the amount they draw is tied to their age. So the younger they are, the less they qualify for. And they borrow money, they access some of the equity tied to their age, and instead of making a payment to the lender monthly, like they normally do with a regular mortgage, with a reverse mortgage, that payment's just deferred to the end of the loan. So it's tacked onto the back of the loan. And when the last person permanently vacates the property, which is normally death, when the last person passes away, the heirs put the property up for sale, they pay off what's owed on the reverse mortgage, the heirs walk away with all the remaining equity.
So
that's the simplest way.
You said a lot of information there that's very important. The last thing you ended with is that when the last person on the deed passes away, then the notes due. And so I think there is some worry there that, are they going to take my home away? But you said that it doesn't come due until the last person on the deed is passed.
Exactly, Chris. And it's important to emphasize when the last person has permanently vacated the property, so that someone could still be alive and vacate the property permanently and still have the loan come due. But yeah, it's extremely important to point out that when you compare a reverse mortgage to a regular type mortgage, we call them forward mortgages in the industry. When you compare a reverse mortgage to a forward mortgage, the main difference between the two is when the interest gets paid back, which is at the end with a reverse mortgage, as opposed to monthly with a forward mortgage. So they're really the same animals. The borrower still owns the property. They still have title. They can sell it whenever they want to. They can pay it off at any time without penalty. They can even make monthly payments on a reverse mortgage if they want to, which totally defeats the purpose of the loan, but they could if they wanted to.
They have that option if they wanted to.
Absolutely.
So how do you know if your home is eligible for a reverse mortgage?
Sure, absolutely, yeah. So, I mean, the very first thing is making certain that the age requirement is met. So assuming the borrower is 62 years old or older, the next most important piece of it is making certain there's enough equity in the property to qualify. With the reverse mortgage, that lien has to be in, so I have to be in first lien position as a reverse mortgage lien holder. So if a borrower has one mortgage, two mortgages, or three mortgages on the property, it doesn't matter how many loans they have currently against their house. What matters to me is the equity that's in the home. So to give you a really generic ballpark idea right now, someone who's 62 years old is going to get access to about 45 to 50% of the value of their property. Keep numbers simple, 50%. So if you have somebody that has a $400,000 appraised value, the FHA reverse mortgage is going to give them access to approximately $200,000. That $200,000 they qualify for must be enough to satisfy existing liens on the property. I have to be in first lien position.
So I always think of this as it may not be the first tool in the toolbox that you go to satisfy some of the medical expenses or things that come up and kind of bite you on the foot when you retire. But if you think about people just having Social Security and maybe they've already gone through, maybe they don't have a pension from their employer. We've seen lots of those disappear, and they don't have that third bucket, that other. They don't have cash savings, or they've already gone through it, but they've got a lot of equity in their home. It could be a tool. It could be an option for you there. What are the differences between home equity loans and a reverse mortgage?
Yeah, absolutely. So, I mean, one of the biggest differences, and we get this question all the time. I'm considering a forward type mortgage. I'm considering a reverse mortgage. What are the differences? That there's a few significant differences. Number one difference with the reverse mortgage: when a borrower does this loan, there are no monthly payments required. So with a regular conventional type loan, a borrower they do a loan, and that amount of money they borrow there's a payment associated with it. Part of it goes towards interest, part of it goes towards principal. With a reverse mortgage, no monthly payments are required. So if they have a lien currently on the property, we're satisfying that existing lien and we're eliminating those mortgage payments. So difference number one is the fact reverse mortgage has no mortgage payment compared to forward mortgage, which does have a payment. The second difference is the qualification piece. We do now have some. They're not new guidelines. I still refer to them as new. It was back in 2015. We now have what's called financial assessment guidelines, where we have to qualify borrowers based on their income and credit. It's not like a normal conventional type loan where we have to do front-end, back-end debt ratios and percentages of income. FHA uses a term called residual income. So we have to satisfy the residual income, and then from a credit standpoint, most importantly, we're looking at the last couple years of property taxes, because defaulted property taxes can spell major trouble for any lender, but especially a reverse mortgage lender. So number one difference is the fact they have no monthly payments. Number two difference is the income and credit guidelines. Those are the biggest differences between the two. One of the most popular options on this loan is a line of credit, which the one great thing about line of credit on a reverse mortgage, a borrower can access that money anytime for any reason without any kind of monthly payment. On top of it, the line of credit remains open no matter what happens to the value of their house. And on top of that, FHA actually has a built-in growth rate to that line of credit. So if they open up a line of credit today for $100,000, month by month, year by year, that $100,000 available grows. So they can actually access more money the longer they have that line of credit.
Does that cost anything to have a line of credit set up? Because I like that idea of having, say, an emergency line of credit that's actually growing. It's got some appreciation on it. Is there a fee to have something like that?
Well, the reverse mortgage itself, to set up the reverse mortgage, that's another piece of this loan. It's not an inexpensive loan, so there are going to be settlement costs involved with a reverse mortgage. One of the largest costs a borrower has is the MIP, which is mortgage insurance premium, and that's 2% of the appraised value. Now, the thing about the insurance that every borrower is required to pay, so unlike a regular conventional type loan, if you put 20% down or more, if you're at 80% loan to value or lower, you don't have to pay MIP or PMI because you have enough equity in the property. With the reverse mortgage, the MIP is required no matter what the balance currently owed is. So when a borrower pays that MIP, it's financed as part of the loan, but that makes the loan what's called non-recourse. All FHA reverse mortgages are non-recourse, and what that means is at the end of this loan, when the last person permanently vacates that property, normally death, at that time, if the balance owed exceeds the value of the property, the heirs actually have protection where they'll sign what's called a deed in lieu of foreclosure and walk away from that property with no liability.
And you mentioned earlier that as of around 2015, there is something that you do an additional what's called a financial assessment where you're looking at credit and kind of red flags if they're behind on their property taxes and looking for residual income. But that is something that's put in place to protect the consumers, where there may not have been that standard in the past. That there is an assessment piece where they want to make sure people can afford the loan before or that the equity's there, that they're not getting into a worse situation.
You're 100% correct, Chris, and that's what this program boils down to. You know, in years past, and before financial assessment went into place, it was viewed as a product like, okay, you're 62, you have a pulse, do a reverse mortgage.
Right.
And it's like, wait a minute, there's more to it than that. So this is absolutely not a fix-all for every single person. Some of our clients cannot afford to remain in their property because when they do this loan, they have no principal and interest repayment on the loan, but they still have property taxes, homeowners insurance, utilities, HOA dues. If a homeowner doesn't have enough income to pay for those things moving forward, even after the reverse mortgage is done, this might not be a good solution for them.
In this process, the financial assessment is put in place to kind of see that, to be able to see if those red flags are there, and if it's bad news, you have to tell them, like, hey, you can't stay in this property. You may just have to tell them that.
You're right, Chris. And here's the great thing about financial assessment. If a borrower doesn't meet the let's say the credit guidelines, so if a borrower doesn't meet the credit guidelines, it doesn't mean that they're turned down for the reverse mortgage, which is another huge plus to this loan. With a regular conventional loan, if a borrower doesn't meet the income, credit guidelines, whatever, sorry, you're turned down. With the reverse mortgage, if a borrower, let's say, has been defaulted on their property taxes the last couple of years, FHA is not going to say that person's turned down. What they say is, okay, this person has defaulted on taxes in the past. It's likely that's going to happen again after this reverse mortgage is in place. In order to protect the lien position, we're going to allow you to still do this reverse mortgage, even though you've been late on your property taxes. But what we're going to do is we're going to establish an escrow account. We call it a life expectancy set aside, so it's called a LISA, but it's an escrow account. So the reverse mortgage will say you can still do the loan, but from a lending standpoint, we have to hold back money that the borrower can't access to pay the taxes and insurance moving forward.
And many people are used to, if you're not paying your property taxes yourself, you've gone the escrow route. So if you had a traditional mortgage in the past, they're used to that. But this one's a special one. It's called LISA. It's an escrow account, and it's just them saying, well, we're going to take a little bit more and put it aside just in case, since you've had those late payments on the property taxes. Let's ask a little bit about, does the house have to be paid off for them to qualify for a reverse mortgage?
No, absolutely not, Chris. The vast majority of our clients have a lien currently on the property. The main purpose for doing the reverse mortgage is to eliminate the outgoing monthly expense of the mortgage. That's the number one reason my clients do this loan. They have a mortgage, there's a payment, they're doing okay, but they're drawing down their assets, they're pulling money out of their savings accounts, their checking accounts, their retirement accounts. That mortgage payment just chipping away. So we come in, do the reverse mortgage, eliminate that mortgage payment. They might not get any money. I have clients who come to settlement and bring money to closing to qualify for the reverse mortgage with the sole purpose of eliminating the payment. So they do not need to own the property free and clear.
So if you think about a lot of the seniors being on a fixed income, if it's just Social Security and the mortgage is it might be the difference between them being able to budget and afford to keep going versus so that could be a possibility or something to look at there. Now I know we're not. Neither of us are tax professionals. I always say consult a CPA, but how do you pay taxes on any cash payments that you may receive?
Sure. Yeah. So again, to preface this with, I'm not please consult with your tax professional. But generally speaking, reverse mortgage proceeds, regardless of the way they receive it, and there are different ways to receive the money. I mentioned a line of credit. There are other options where they can actually receive a monthly payment from the lender. Regardless of how the borrowers receive that money, it's not taxable because it's not classified as income. It's just a loan against the property. So generally speaking, this loan is not susceptible to any type of income taxes or federal taxes because it's just a lien against the property.
Do you have any stories where you've worked with borrowers that you've seen that you'd like to share with listeners where you've seen this be a really good fit?
Yeah, absolutely. I can tell you probably one of the most significant ones, and this just happened recently. And again, like I said earlier, the majority of my clients do have mortgages on the property. I had a client of mine earlier this year, whatever it was. We were doing a reverse mortgage for him. Let's say 62 years old, property worth $600,000. He qualified for $300,000. He owed like $325,000 on his existing loan, so he was $25,000 short in getting into the reverse mortgage. we had him pull money. He had money in his savings account. We had him pull $25,000 out of his savings account to pay down his existing loan to get into the reverse mortgage. And people say, well, you know, why would you have people pull money out of their savings to pay down the loan? I thought they got money with this loan. Well, this is a prime example. This person had an interest-only adjustable rate first mortgage. So his rate had just adjusted and his payment had converted from being interest-only to full principal and interest. His payment was going up to almost $4,000 a month.
Wow.
So we had him pull $25,000 out of his savings account, pay down his loan. He got into the reverse mortgage. He eliminated a $4,000 a month expense. So he basically increased his cash flow by $48,000 a year. He had a part-time job the day of settlement. He had a part-time job. He wanted me to go with him. He's like, Eric, you're going to go with me. I'm going to quit this job. He had a part-time job he was quitting because I just basically gave him $4,000 a month in the form of no mortgage payment.
Wow. You know, that tell us a little bit about sorry, I'm going to pause just for a second because you mentioned that was an interest-only loan. We don't see a lot of those anymore particularly, but if we think about before the housing bubble, people were living off of their equity in California, and that was just kind of they would do the interest-only or variable rate mortgages, and the idea is that, so people, there have been some safeguards put in place now, but the idea back then to see your mortgage go from, you know, double or triple what you were normally paying, I mean, it can really offset somebody's budgeting, especially if they're on a fixed budget. Let's go back a little bit about the certified reverse mortgage the certification that you have, because I'm interested in finding out a little bit more about that. Now, you were the first person in the U.S. to receive this?
Very first person in the U.S. Yeah, it was back. You know, see in the industry, just like any type of industry, you know, there are lots of people who offer products. There are a handful of them that specialize in it. And when the designation first became available, I just worked very diligently at getting that designation. So yeah, I'm one of a handful. I think there's about maybe 100 people in the whole United States that have that designation right now. And it just tells my clients and everyone I deal with that you're dealing with a professional. You're dealing with somebody who lives and breathes the product, who has had background checks, testing, continuing education, ethics classes. I'm required to keep up with CE credits every year. Minimum number of reverse mortgages have been settled. So it's a matter of dealing with somebody who specializes in this product, because there are a lot of moving parts with a reverse mortgage. You want to make certain you're dealing with somebody who understands the program.
So I'm a big advocate for that, the idea that you're having to keep up your continuing education. If the laws change, that this is all that you do.
100%.
Compared to, you know, just a general lender that may do reverse mortgages, but they may do all of these other different types of loans, and so you have to question: are they keeping up with the current laws and how this works? Well, tell me a little bit. We talked about this earlier, but how does this affect your estate? Can you go a little bit deeper into that?
Yeah, I mean, so generally, when you look at, I mean, in the rawest sense, a reverse mortgage is basically someone opting to use part of their equity now while they're alive, as opposed to after they pass away. So in theory, what someone is doing is that they're utilizing this loan and they are lessening the amount of money that's going to be left over for the kids and for the estate, for the heirs. I mean, that's the most general way to put it. When a borrower's doing this, they're accessing equity now while they're alive. They're deferring interest, so it's a negative amortization loan, meaning that the interest is accruing on the back of the loan. The balance is going up. So essentially, what they're doing is, I mean, they're reducing the size of their estate because they're using the equity now while they're alive. I mean, that's the simplest way to put it.
But for many, that may be the only option there is. And
absolutely. And, you know, what our clients do too, Chris, is, you know, they'll gift, they'll do this loan. They'll say, hey, you know, the kids are getting everything after I pass away, but I don't want to wait until I die. I want to do something for them now. So I'm doing this loan. I'm paying off my mortgage. I'm doing some home improvements. And on top of that, I'm going to take out some extra money. I'm going to gift the grandkids a little bit of money, gift you something, start at 529, and then just know upon my passing, you're still going to get all the equity left over. It's going to be less than it would have been today, but you're still going to get what's left over, but I want to do something for you now. So, yeah, it's a great tool for them. They feel good about it, too, because they're still alive and get to see their family enjoying the money.
That's something to think about, absolutely. If you're helping kids towards college tuition or something like that, and you're still here to see the smile on their face, it's a good thing. Well, let's talk about, you mentioned a little bit about some of the ways that they can receive the payments. Are there more than that? Can you tell us the different ways that you can receive payments?
Yeah, absolutely. So it's important to point out that the lien, if there are current liens against the property, they must be satisfied first. That's very important to point out. Once liens have been satisfied, the remaining equity that's available to them can be received a few different ways. The most popular option by far is the line of credit, where they just leave it in the line, they access it when they need it. If they don't need it, they don't draw it. And there's also the growth rate built into that we talked about. That's the most popular payment option. But there's also a monthly payment option, and within the monthly payment option, there's two available features there. So the one is what's called a 10-year payment, and with a 10-year payment, that's a set amount of money the borrower receives from the lender every month indefinitely, as long as they're alive and living in that property. No matter what happens to the balance of the loan, to the value of the property, they will receive that amount of money indefinitely as long as they're alive. That's a 10-year payment. The other payment option is what's called a term payment, and on a term payment, the borrower tells the lender, I want X amount of dollars per month, whatever the shortfall might be. On a term payment, we run that through the FHA calculation, and it says, okay, based on this age, based on this value, based on this equity, and this amount of money that you want to receive per month, you'll receive it for 18 months, 32 months, 57 months. So with a term payment, the borrower sets the amount they want to receive, but it will run out at a certain time frame. Now, when it runs out, they don't have to sell or move or anything like that. The money just stops coming in. So the easiest way to explain it is there's a line of credit feature, there's a monthly payment feature with the reverse mortgage.
So this sounds very similar to when people get pensions and they have to make a decision between taking the whole pension, or if they, you can kind of dial in the amount. You can back into it by saying, I need this amount, and it stretches out how far it will pay for. But the important part is to make sure that you're working with a professional like yourself, so that all of that is clear and transparent, that there's no surprises, and you only get it for 18 months, and then 24 months later you're like, where's my money?
Exactly, and that's not a real popular payment option. But the other thing to point out with that too, Chris, FHA does give the borrowers the ability to change these options at any time. So if one no longer suitable, if they come into a chunk of money, or they want to stop working or start working, these payment options can be changed any time.
Now, what different property types are available for this? Is it just single-family residence, or can you tell us a little bit about that?
Yeah, absolutely. So it has to be primary residence. That's number one, first and foremost. The property must be the borrower's primary residence. Single-family homes are great. Condos are okay, but we do have to have FHA approval in order to loan on a condo association. But generally speaking, they're single-family houses or condos that are FHA approved. And again, it's extremely important to emphasize, must be primary residence. FHA does not loan on any type of investment properties or second homes. This loan is specifically for owner-occupied properties. So
that's important to know. So this is a home that you live in. It is not an investment property or a vacation home or anything like that. Single-family residence. It can be condos as well, but they have to be FHA approved. Yep. Well, we're bumping right here towards the end of the show. What else would you like to share with listeners?
I think the main thing, Chris, is it's just extremely important for any professional in this industry, like any industry. But before borrowers get into this loan, it's extremely important for them just to research it. We always recommend they get financial professionals like yourself involved. The more people that you have looking, listening, researching, the better off our borrowers are. So the big takeaway is always making certain that they get trusted people involved to help them make decisions. They shouldn't do it on their own, but ultimately they have to do what's best for them. So take the advice of anyone they talk to, but make certain at the end of the day they realize they're the ones that are in need here. So the kids might not be crazy about it because they get some less equity at the end of the loan, but it's extremely important for them to research it and to get people that are knowledgeable to help them out with that.
Absolutely. Now, to find out more about Eric, you can reach him. The website is www.reversemaryland.com. Is that right?
Yeah, absolutely, Chris. ReverseMaryland.com.
And even though it's Reverse Maryland, you are licensed in all 50 states, or does it depend?
No, me personally, I'm Maryland, Virginia, and Florida. I tell I get a lot of referrals here, so I tell anybody that calls in or emails me, whatever. I have, I can put them in contact with someone reputable. I can do some research in any state and find somebody who's reputable. Hopefully, someone who holds the same designation of CRMP to get them in contact with someone that can help them locally.
Perfect. Well, Eric, thank you so much for being on the show today.
Thanks for having me, Chris. Appreciate the time.
Absolutely. And you have been listening to KPFT Houston.
Thanks for listening to today's episode of Money Matters Podcast. If you enjoyed the show, visit us on the web at www.moneymatterspodcast.com. Drop us a line on SpeakPipe on the right-hand corner. It will receive any voicemails, questions, thoughts, concerns that you have about the show. In addition to this, we recently launched a Patreon campaign. Click on the Donate Now tab to hit the tip jar and find out what Patreon's campaign is all about.